Good morning. Today is Friday, November 4th. We have that big jobs report. So we're going to zip through some earnings that came in last night and into this morning, talk a little bit about hiring freezes, but then we're going to address the jobs report, which kind of flies in the face of some of those hiring freezes. I don't want to bury the lead too much. So first of all, Starbucks reported last night strong comparable sales per store. In North America, you're talking about 11% growth, which sounds great, but ticket price drove 10 points of that growth. So really only traffic increased 1%. So it did help margins. That's good. And they did move guidance for the fiscal year, which ends next September, to the higher end of their range. I would say for Starbucks that I do think that they're doing the right thing in terms of just pushing pricing, because at some point you just can't get more traffic through the stores. At the same time, they continue to lean heavily into China. China seems to have deteriorated again in the last few weeks due to more COVID shutdowns. And they're just pushing pricing. It's unbelievable how much you pay now. You go to Starbucks. I went to Starbucks this morning because Julia really wanted to sample the new holiday beverages. And I got a wrap and an Americano. She got a drink and a pastry, and it was $20. It's unbelievable.
It's a robbery.
So Starbucks up 2% pre-market, at least it was after this jobs report. It may have been, may now be lower. I don't know where it is right now. PayPal was down 7% after reporting earnings that actually beat estimates. They're doing very well on their cost control, really cutting down on that. So you're able to beat on the net number. However, on the top line, they are seeing some weakness. That they now see total payment volumes of just 8.5% for the year, down from 12%. And more importantly, they see substantial decline in their total payment volume on their platform. They went from over the first 4 quarters this year, they went from 15 to 13 to 14, and now they just guided to 9%. So a big deceleration, and that normalizes out your currency. You add currency on top of that, and you're talking low single-digit growth for PayPal. They are definitely seeing declines. They saw U.S. e-commerce growing in the low single digits in Q3 with deceleration into the close of the quarter. That trend persisted in October. In addition, they have not seen the early start to the U.S. online holiday season that they saw in 2021. And, I think this is echoes what we heard from JB Hunt, that the holiday season is pretty much non-existent. Heard from Amazon. There are some companies here and there. Microchip, for example, this morning reported very good results, saying that they're not seeing any weakness in their business right now. But certainly PayPal is. And I think this ultimately gets to what is discretionary in this economy and what is not discretionary. Starbucks is making the argument that coffee is not discretionary right now. Mondelez made the argument that chocolate is non-discretionary right now. PayPal, online shopping, seems a little bit more discretionary than people thought.
Yeah, I think that this really goes into the overall mosaic of what we've seen this earnings season, which is the trend of the last 10 years, the Google, Apple, Amazon, buy everything online, have it shipped to your house, sort of mindless consumerism seems to be crumbling very quickly. And I was talking to one of the interns yesterday afternoon. It's kind of an interesting conversation because I was saying that when I was their age, when I was an intern at SunTrust, the biggest companies in the world were ExxonMobil and Walmart. Like the Apples, the Amazons, all these companies were up and coming, but they weren't what they are now. And I think it might be time to consider, what are going to be the 10 biggest companies in 2032? And is it possible that they could be Exxon and Walmart? Is the trend of the sort of 1999 to 2020, is that over? Is it time to consider, what are the true all-time stalwarts of the stock market, particularly in a time like this? So something kind of just interesting thought exercise. Whether or not it really plays out is something to consider. But I think that's really the trend we're seeing right now. Some of these the overarching theme here seems to be that the e-commerce space works all well and good when things are good, and then when they're really not good, the whole sort of ecosystem begins to collapse on itself. The PayPals, the Shopify's, the Amazons, the Apples, the Instagrams, especially particularly Facebook and Instagram, have just gotten crushed. So something to consider, just sort of as part of the mosaic in the market right now.
Yeah, it's interesting world right now.
Ben was listening.
Speaking
Got him.
speaking of Amazon, actually, they are pausing adding new corporate workers right now due to uncertain economy. This includes their Prime business and Amazon Web Services, which I think is significant because Amazon Web Services was supposed to be the stabilizing piece of the business. Apple paused hiring for many jobs outside of research and development. So if you're on the R&D side, you're good. They continue to hire for that. But if you're involved in corporate functions or standard hardware and software engineering roles, you're getting your team is being frozen. Lyft is freezing hiring until next year. They're also planning to cut 13% of its employees. They report earnings next week. Qualcomm is freezing hiring. Twitter's planning to fire 3,700 people. Elon Musk also intends to reverse the company's work from anywhere policy. So maybe some of those people will self-select out.
Yeah.
But there is some anecdotal evidence similar to what we saw over the summertime about these hiring freezes. What was interesting about the summertime is that you saw gradual upticks in those weekly jobless claims, but you never really saw the big national numbers really report that from the end of the month. And I'm wondering if we're seeing some of that again.
Yeah.
So switching gears, hit us with the numbers from the employment report this morning, Tom, and then we'll get some context for that. But we were hoping for a little bit of a decline in the number of new jobs created in the month. And we're also hoping for a little bit of decline in the average hourly earnings growth. So where are we and where are we going?
So I would say this is a good news is bad news scenario. So the surveyed number for change in non-farm payrolls was 193,000 new jobs. We actually came in at 261,000 new jobs. So about a 30% overshoot. And in addition to that, last month's number was 263. They revised that number up to 315,000. So you're looking at basically a net extra of like 160,000 extra jobs, in addition to the fact that we were only supposed to get 193 this month. So the Fed raising interest rates, crushing the jobs market, all this anecdotal evidence that, some of these tech companies are going to start laying people off. Well, the opposite is happening at the moment. We're seeing massive job gains. Just across the board. And not only that, but revisions for the massive job gains we saw last month. In addition to that, the other number we really like to look at, labor force participation rate went down. It was expected to be 62.3, so we're at 62.2. So people are net leaving the job arena. And then on top of that, we're hoping to see some deceleration in average hourly earnings year over year. The expectation was 4.7%, and that came in at 4.7%. So last month's print was 5, so we're down a little bit, but still, wage inflation is definitely very much on the table at the moment.
And I think on the average hourly earnings, you also have to look at the month over month, because right now we're so intensely focused on this that you have to look at the granular detail and see where we are going in the immediate term. And that was up 0.4, which was an acceleration from last month. So the reason that we went from 5 to 4.7 is because we're comping over a tougher period from last October. But if you actually look at the month over month seasonally adjusted number, you're actually talking about an acceleration in wage growth. And that's not going to be good for the Fed. And now maybe they look at year over year numbers. I don't know. But I would be looking at the month over month to really ascertain where we are right now. And unfortunately, this fits with a lot of the other data that we're getting. The GDP now for the fourth quarter is 3.6%. The inflation has been accelerating, and that's sticky price inflation. You had prices paid from the ISM services yesterday actually tick up. You had employment go down a little bit, new orders decelerate a little bit, and some of the other numbers. But on the whole, I don't think you can really say that inflation is peaking out, and therefore I don't think that you can say that the Fed is anywhere really near done in terms of this rate hike cycle. And especially if they need to get those interest rates above the inflation rate, the core inflation rate, even wage inflation, you're talking at least getting to 5.5% on the federal funds rate, which would require another 150 basis points or 6 rate hikes. And I would expect that needs to happen relatively quickly.
Yeah, if you look at the curve here on Fed funds rate futures, we're looking at about 6 hikes now, peaking out in June. I mean, it just adjusted live while we're watching. We're seeing rates sell off. Obviously, the narrative coming out of this jobs report is that the Fed has made very little progress. In fact, we're accelerating the other direction. I mean, the 3.6% GDP number on the GDP now is a very strong number, really, for any year. To have that big a number for a quarterly increase in GDP. So the effect that the Fed is supposed to be having with these interest rate hikes is definitely not happening, at least not in the short term. So I would say we have to continue to prepare for more rate hikes.
So where are we seeing the job growth? We're seeing it in healthcare. There's 53,000 gain last month. Professional and technical services, 43,000. Manufacturing, 32,000. Social assistance, 19,000. I mean, leisure and hospitality, 35,000. We saw it across the board. There just weren't that many places where there were declines in the workforce, a little bit in information, and maybe a little bit here in retail trade. But on the whole, you're seeing significant job growth, and it's broad based. It's not just because of leisure and hospitality, which it had been for some time. The other thing that I would know is you can also get some insights on individual companies by looking at these jobs reports. And that's what we try to do. So if you look at the healthcare, gain of 53,000 in a month, that's a very rapid gain. And that's good for a company like HCA, which we own. So we're going to take that information, and if that's weak today, it could allow us an opportunity to purchase some shares of that hospital chain, because they are now having more employees, which is debottlenecking some of that area. You're also seeing continued growth in architectural and engineering services. That grew 7,000 employees in the last month. Well, those guys need Autodesk, which is a software package, AutoCAD, which is a software package sold by Autodesk. That's a company that we own. And that continues to look good too. So these are ways that you can look at this, but the big takeaway is I don't think you're checking the boxes that you need to check, that the Fed wants to check, that suggests that inflation is really coming down. In fact, we get the inflation report next Thursday, and I'm interested to hear your thoughts on that, Tom. But I don't know if we expect much of a deceleration at all when that comes.
I don't think so at all. I mean, especially given that the GDP now got revised up. I mean, if anything, I would say that we're looking at a hotter number than expected, which in every other year would be awesome news. Maybe outside of the taper tantrum back in 2013 when we were in a sort of a similar situation. But everyone was worried about ensuing recession. Were we in a recession during the summer? Well, now, we made up any retraction from the summer and more, and it looks like we're about to accelerate even hotter into the final quarter of the year. So I think all the risk is the upside in rates. That's where I continue to lean. I've been leaning that way kind of the whole year, and I would expect that to continue. So we're trying to adjust fixed income to avoid the volatility, but I mean it's just going to be pretty continued. But the good news is, and I know we say this every call, is that every time we buy a bond, we're getting, orders of magnitude more income than we have for the last 15 years. And so, even if there's a little bit of volatility on the front end, as we try and find sort of the water line in terms of rates, it's a lot better than getting paid 1% on muni bond when you can get paid 4 or 5, get it back in 3 years. And if rates are higher, you can get 5 or 6. And so that's, the good news, but in the short term, it's going to be volatile. The numbers are going to look a little rough, but the good news is we are buying individual bonds that we know are going to mature, so you'll get that par back, provided we do the credit legwork, which is, 9/10 of the battle.
Finally, I would just note, we do have oil prices that are up rather a decent amount today. We continue to do work on the refinery bottlenecks. That does appear to be the main issue, primarily because a lot of refineries have been taking offline. So we have a bottleneck where we have plenty of oil right now, but we're not getting it through the plants because we don't have enough plants. And I think that the oil price has been artificially depressed because there's no place to put the oil, because you have that bottleneck in the refiners. And we just keep releasing this oil from the Strategic Petroleum Reserve, but it's just going into storage because we don't have the refining capacity. So that's where we stand on that. And I think once the SPR releases kind of go away, you might see oil upwardly mobile. That's what we're seeing this morning. 6.6% is the estimate for core CPI next week. That's what the Cleveland Fed Inflation Nowcast has. Last month, it was also 6.6%. That's going to be something that we're watching closely. Right now, bonds are down, interest rates are up, and actually, interestingly, stocks are up. So we'll watch that closely today. It'll be interesting if that rally can be sustained. That would be a good sign going into the weekend. So with that, have a great weekend, have a great Friday, and we'll see you on Monday. Bye.